Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, so last week I gave a homework about the duration, and I just posted the solution for that homework answer. I don't want to talk about this solution, and you can compare your answer with mine. All right, that's about homework answer. And the tutor, Kwang, already graded your first assignment. But now, because the office lady was on vacation last week, so she told me she needs a few days to upload your assignment marks online. So probably you have to be patient for a couple of days. If you really want to know your assignment mark, you can go to the main office on the 4th floor. If they have time, the office lady, they can show you. But anyway, if you don't want to go to their office, you need to wait a few days more. That's basically what's going on with checking your grade online. Okay, I will post your midterm mark probably early next week, next Monday or so. Or in your next tutorial, you will give 10 to 15 minutes to check the written part of your exam. If you have any problem or if you think the marking is wrong during the tutorial, you can write it down and submit a form to asking for remark. So that's about next week tutorial. You will have 10 minutes to do that. Okay, so today's material, we move on to this chapter 24. So it's about portfolio performance evaluation. So what's the central question of this chapter? So for each fund, for each portfolio, typically a professional fund manager. For example, suppose we have 3 funds. This is just example. This is a fund ticker. It's just a name, shorter name. And each fund, they have a time series. They have to disclose this information. This is past performance of each of those funds. Every month, they need to report you the return of the fund portfolio. So over the past 10 years or 5 years, whatever you want, you can have a long time series of each fund performance, right? So this is some data you can easily get. Typically, it's free from some database or from, there are many resources. But the question in this chapter is, given the historical return of those portfolios, how to evaluate this portfolio performance or evaluate this fund manager. It's actually evaluate of the manager rather than the fund. So the starting point of evaluation is very simple. Just calculate the average return, right? That's the first step people can think of. Just calculate the average return, no matter it's 100 monthly return or 500 monthly return. So, but technical detail is about, if we're talking about average, there are different types of average. A simple average, also called arithmetic average, is just a simple, right? Sum all those monthly returns up and divided by how many months you have. So this is arithmetic average. A good thing about this type of average is it's an unbiased estimate of expected future return. So if you want looking into history, to tell you something about future performance, then this average is an unbiased estimate. Another average is called geometric average. So the definition of geometric average is simply rather than the sum of the return, you have times each individual monthly return all the way up, then have a power 1 over n. So this is another way to do average. This average is called time-weighted average. So this tells us about the actual performance over the past period, right? So return, next month's return, all the way. So that is the accurate way to tell what really happened. But there is another type of average, it's called dollar-weighted average return. The definition of dollar-weighted average return is according to this. This is present value, PV, present value, and C1, C2, Cn is the cash flow at each point of time, the different point of time. And this R is also called internal rate of return, IRR. Obviously, if you look at this formula, it's weighted by the amount of cash flow, right? C1, C2. If cash flow is bigger, then this weight is bigger, right? So this is called dollar-weighted average return. So, for example, I just give a simple example. Like, suppose today you purchase a stock at cost of $100. So that's today. Then at end of the first year, you received a $5 dividend. And at the same time, you bought an additional share at a cost of $110. So that's the end of the first year. Then at the end of the second year, your 2 shares paid a dividend of $6 each, and you sold your shares for $115 each. Okay, this is just given all those numbers as in the question. Then the question is, what is the average rate of return over the 2-year investment period? What's the average rate of return? Then you need to ask what kind of average, right? Otherwise, there is no unique answer. There is no unique answer unless you know what kind of average we are looking for. For example, if we know the first year, the return is, holding period return of first year is the end of year cash flow minus the cost, right? Then over the cost, then the first year return is 15%. The second year return is this end of that period price plus dividend minus the price at the beginning of that period over the price at the beginning of that period is 10%. Then we calculate average. So this is arithmetic average or simple average. It's just you have a sum of those 2 periods then divided by 2. So a simple average is just 12.5% per year. But this geometric average is different. Geometric average, according to the formula, you will get a slightly different answer, 12.47%. Slightly different. How about the internal rate of return, IRR? If you, according to the formula for IRR, the present value at the beginning of that 2 years, your investment is 100, okay? At the end of the first year, your cash flow is you have $5 dividend, but you buy additional shares, so there is a negative cash flow because you purchase additional share. So this is a cash flow at the end of the first year. This is a cash flow at the end of the second year because you have 2 dividends with $6 each. and you sell those 2 shares at 1.15 each. So this is the final cash flow. Then you can easily get, if you plug this into any financial calculator, you can easily get this internal rate of return. This is also called dollar-weighted average. Okay, this is dollar-weighted average. So which you can, obviously you can say this, arithmetic average is different from the geometric average, which is different from the dollar-weighted average. They're close, but different. So anytime if you want to do comparison, if you compare performance of fund A to performance of fund B, so people want to make sure you compare with the same average, right? You can compare fund A's geometric average with fund B's time-weighted average. That would be compare apple with orange, right? So first of all, average, but you need to compare same type of average. But a question, technical questions in our example, why is the dollar-weighted average slightly less than the time-weighted average? So this number is slightly smaller than that time-weighted average. So what's the intuition? The intuition is straightforward because more money is invested in the year 2, right? Because you buy 2 shares in the year 2, your money, your investment bigger, but the realized return of year 2 is smaller than the realized return of year 1. But you have more money for the year 2. So if this is a dollar-weighted average, then this lower return will have bigger weight in your average calculation. So that is why the dollar-weighted average would get a lower number because it put bigger weight on the second year. So that's an intuition why the dollar-weighted average is a little less than time-weighted average. Okay. But we just talk about average return, right? We want, the essence of this chapter is we want to evaluate the performance. But the performance can be meaningfully evaluated unless we need to take into account of risk. Cannot just compare one average return with another average return without talking about risk. So we need risk-adjusted measure. And the simplest way to do this adjustment for risk is to compare a fund's return with the return of other similar funds. It's straightforward, right? If you're a fund manager, we just look at similar funds like you and do the ranking. That's an easy way. And there is a phrase talk about this similar funds. It's called comparison universe. That's a big word, but it's a convention to call it this way. Comparison universe. So what is comparison universe? It is a group of funds or portfolios with similar risk characteristics. For example, if you are a manager of a growth fund, then all other growth fund would be your comparison universe. Okay. If you are a manager of a high yield bond fund, then all other high yield bond funds, they are your comparison universe. So it depends on what type of your fund. So this is an example I copy and paste from the textbook. Example is, suppose we have a fund so-called Markowil Group. This is the name of that fund. And this whole rectangular means the universe, comparison universe. All the funds similar to this particular fund. So what we need to do is we look at the ranking ranking is represented by the dot. The black dot represents this fund. Is in the middle or is belong to the top 25% or below the medium. So our advantage of this university comparison is straightforward. It's very clear. Just look at the position of the dot in the comparison universe. Then you can straightforwardly to tell it's good performance or bad performance, right? And it also depends on how long you need to look into over the past. For example, the past 1 quarter, then this fund performance is not bad. It's above the average. But if you look at the past 1 year, then the performance is not so good, below the medium. And the past 3 years, the past 5 years, this performance is not good, below the average. So this is basically a simple idea. The average return of each of all the funds similar to each other were ranked within the universe. And in this graph, there are 3 dashed lines corresponding to the top quarter, bottom quarter, and all the medium 2 quarters. Right? This is called universe comparison. This is one way to adjust for risk. But the problem of this methodology is the selection of comparison universe sometimes can be very much misleading, especially if you want to mislead your investor. As suppose you are a manager, you want to mislead your investor, you can artificially choose some universe that mismatch with your true type. Then your ranking could look good. So you want to compare yourself with someone not really similar to you. So that's potentially a problem. Even within particular universe, a fund manager may concentrate on some particular subgroup. So the fund characteristics are not truly comparable. Right. So that's a potential problem. Just like this example. This example. If you compare your performance with all those growth funds, suppose you are a growth fund, but even within this growth fund, there are many different subtypes. Right? You probably just belong one subtype of this whole universe. Then if you just belong one subtype, you cannot compare you with the entire universe of this growth fund. But in practice, you could do that because nobody will look carefully into that comparison. So this could be misleading. So we need more precise risk adjustment performance measure. Right? This is a list of those performance measures to tell whether you are a good manager or a bad manager. So that's a central question. You are a good manager or bad manager. And we have talked about some of those measures in our previous lectures. We talk about alpha a lot. We talk about Sharpe ratio. So in this lecture, we just systematically to wrap all those things up. So the first is Sharpe ratio. Right? Sharpe ratio definition, we have been very familiar with the definition of Sharpe ratio. Sharpe ratio of your portfolio is your excess return. This is average, historical average, over the standard deviation. Right? Typically, people will finally annualize the Sharpe ratio. So if you have, just like in your assignment 2, you have monthly data to calculate standard deviation and excess return. So eventually you will get monthly excess return and monthly standard deviation. but you want to annualize the whole thing. Remember, the standard deviation is proportional to the square root of how many periods you have. So the annualized standard deviation would equal to square root of 12 times the standard deviation of monthly return. But the annualized return would equal to 12 times the average monthly return. So you have a 12 on the numerator. You have square root 12 at the denominator. So altogether, you just times the whole thing with square root of 12. So annualized Sharpe ratio equal to square root of 12 times the monthly Sharpe ratio. I have talked about this in our last week, so I just repeat it again in case you don't make this mistake. Okay. So the measure of return is excess return. It's very straightforward. The measure of risk is portfolio standard deviation. A good thing about this measure is don't rely on any asset pricing model, because given your performance, given this is a performance, historical performance of any fund, once you have this number, you can easily calculate this excess return over the standard deviation, isn't it? For example, in this case, we have 3 funds. Suppose for this fund VTCIX, we want to know the Sharpe ratio over the 10-year. It's pretty straightforward. Average monthly return over the standard deviation of this return, then altogether we annualize with square root of 12. So this is the Sharpe ratio of this particular fund, right? 0.42 something. Right? And it doesn't depend on any asset pricing model. It's easy to calculate. So when should an investor care very much about Sharpe ratio? Because Sharpe ratio is just one of the, remember, Sharpe ratio is one of the performance measure, right? So when this Sharpe ratio is most important, if you are an investor and if this investor performance can be summarized by mean variance utility function. This is a long time ago. In our second week, we talked about this utility function, right? Then this utility function is our starting point. Then eventually, if you remember, we looking for the portfolio gave us the tendency portfolio. That's tendency portfolio gave us highest possible Sharpe ratio. Then we say, okay, that's the best, that's the optimal risky portfolio because of high Sharpe ratio. This is what we learned in chapter 7. But this utility function is always a starting point. In our nature, we just take it for granted that utility function can be written this way. But you will say that many people argue that this is oversimplification. People's utility is more complicated. But we just skip all those material. If you write utility function in another way, then what the conclusion would be? That's not our material. But typically in practice, this utility is the most popular one. And in academia, of course, you want to go to more complicated utility and draw some new conclusion. That's what innovation is about. But still, this is the simplest utility function, and in practice, people still use it a lot. So if you take this utility function as granted, as given, then you should looking for tendency point. Then you should looking for the highest Sharpe ratio. That's Sharpe ratio. So the Sharpe ratio depends on this assumption at the beginning. And also, you should look for the highest possible Sharpe ratio if this fund is the exclusive risky investment of the investor. So which means this fund is your entire portfolio of risky investment. Your entire risky investment is just investment in this fund, no others. But what if, in contrast, if this fund is just one of your many risky portfolios? Suppose you simultaneously are investing in many different funds. For example, 10 funds you are investing, and this is just one of the 10 funds you are investing. Then you will looking for Treynor ratio rather than Sharpe ratio, because Sharpe ratio represents the entire risky portfolio of yours. I will talk about Treynor ratio later on, but this is the difference. When you should looking for Sharpe ratio, and when you should looking for Treynor ratio instead. So Sharpe ratio is actually equivalent to M squared. So in other words, M squared is the equivalent representation of Sharpe ratio. It's just redundant. So if this is redundant, why do we need M squared? The starting point is there is Sharpe ratio is very useful, but suppose we have two Sharpe ratios. The market Sharpe ratio, suppose 0.73, and your portfolio's Sharpe ratio 0.69, and the difference is 0.04. But the question is, what does this 0.04 mean? It doesn't really have a unit. This is not 0.04 return. This is not 0.02%. No, it's not. So if you say the difference is 0.04, so what does it mean? It's hard to say whether it's economically meaningful or not. Right? It's not straightforward to see. So that is why we need an equivalent representation of Sharpe ratio to make it straightforward. So what's the definition of Sharpe ratio? It's just a procedure. First of all, you need create adjusted portfolio P star. Suppose P is your fund performance. Okay, this is the mean standard deviation plane, and M is the market portfolio, and P is your portfolio, your fund. Okay, and your Sharpe ratio is lower than the market Sharpe ratio. Why? Because Sharpe ratio, remember, is the slope. But we need to compute another thing called M squared. First, we create a new portfolio called P star. P star has the same Sharpe ratio as the portfolio P, so which means P star should on this capital allocation line from risk-free asset to P. Then P star and P share the same Sharpe ratio because they have the same slope, right? Then second step is definition. P star should have the same standard deviation as market index, as the market portfolio. Then you start from the market portfolio and draw a vertical line to cross it to this capital allocation line. Then P star is right here. So this is where we create another portfolio called P star. Then the definition of R squared is straightforward. The return difference between your P star portfolio and the market portfolio. So R P star minus RM. So the difference, that's M squared. So I don't know why it's called square, because it's not squared, but as I said, this is convention. Well, so M squared is just the difference between the return of P star and return of market. In our case, this is negative, right? So you can easily say that the M squared is equivalent representation of Sharpe ratio. Why? Because M squared is proportional to this slope, right? If your slope, the P has a slope much larger than the slope of the market portfolio, then the M squared will be positive. Suppose P portfolio is somewhere here. So a larger slope will generate a bigger m square, and a smaller slope will generate a negative m square. So this is, but the nice thing about m square is it has a unit as return, right? For example, suppose we have a fund, this fund portfolio has a return 15%, standard deviation 42%. And we know the M portfolio, the market portfolio has returned 18% standard deviation, 30% standard deviation, and the risk-free rate 6%. Given, then we want to calculate M square. Then, first of all, how to construct P star portfolio. I just skip a little bit step. To construct P star portfolio, we need to put a weight 30/42. Why 30/42? Because this is the ratio between the standard deviation of P portfolio and standard deviation of market portfolio. You want to double check if you are not convinced with this number. A weight of this 0.714 in P, and the rest of weight in risk-free asset. Then why we want to have this combination of weight? Because we want P star portfolio has the same standard deviation as the market portfolio, and with this weights, then the P star portfolio will have the same standard deviation as the market. Then what's the return of the P star portfolio? We have weight, then we just plug weight and return of each of this. Then the P star portfolio has a return 12.43%. Then what's the M square? M square is the return of P star portfolio minus the return of the market portfolio. And this is M square. So the whole advantage is now it has a unit as percentage of return, right? That's the whole point why we need M square. Now we can say, okay, the M square is negative 5.57% per year. That's huge. We can say economically it's huge. Why? Because we know on average the stock market can give you an annual return 7% or 8% per year, but the difference is almost negative 6%. That's economically very big, economically very meaningful. So that's the advantage of M square. Okay. So the next measure of performance is called Treynor ratio. The Treynor ratio is defined by this formula. The return is excess return exactly like before, but the denominator is the beta, the market beta of this portfolio, the market beta of this fund, rather than standard deviation, right? So that's the main difference. Treynor ratio differs from Sharpe ratio. But in this case, you need to calculate the market beta, right? To calculate Treynor ratio, you have to calculate market beta. So in our case, we use the same fund. So this is our fund past 10-year performance, and I just give your market excess return here. Then to calculate Treynor ratio, let's say, first you need to calculate beta, right? The definition of beta is the covariance of your return with the market excess return, right? So the covariance of those two time series, the covariance between your return and the market excess return, this is the numerator, over the variance of the market return, right? So this is how we calculate beta. Then this beta is fairly close to 1. Once you have beta, then the training ratio equals the average return of your fund over the beta. This is the beta, right? Then y times 12 because I want you to, this is average monthly return. I want to annualize it. So this is a training ratio of this fund. Anyway, we can compare with the Sharpe ratio of this fund and training ratio of this fund with the market portfolio. For example, the Sharpe ratio of the market portfolio is the same thing. Sharpe ratio, remember, the average return over standard deviation. So for the market portfolio, you use the Semner formula. You can see the Sharpe ratio of this fund is lower than the Sharpe ratio of the market, right? How about training ratio? Training ratio of the market fund, look in a second. Training ratio of the market fund is what average performance of the return over the beta of the market. But the beta of the market is 1 by definition, right? So I didn't divide it by 1. I should divide it by 1, but it's just the same thing, right? So this is training ratio of the market portfolio. And you can see, according to training ratio, this fund also underperform, right? So a question is, what exactly is this fund? So you think maybe I fabricated this number. Actually, I didn't. Okay, what's that fund? Is this one way to open it? So remember, the fund name is called VTCIX, right? That's a ticker name. Where is VTCIX, Vanguard Tax Managed Capital Fund. So those returns are real number, not I fabricate. Look, they rank as the number 3rd in all those categories called lot blend, overscore 9.6 over 10. Looks very much like a star fund. And so this is ranked by this U.S. News, right? U.S. News rank a lot of things, including university ranking. Sorry, right? And actually, everybody cites their university ranking a lot. And they also rank those funds. And this fund, VTCIX ranks the number 3. That's very good. But if we don't just look at the ranking, we look at the real performance, I would say it's quite disappointing. Would you agree with me? Look at the Sharpe ratio. Look at the training ratio. Quite disappointing. So sometimes you cannot really trust those commercial ranking. Can you? I don't think you can really trust. Anyway, so this is about training ratio. So why sometimes people want to look training ratio? So if the fund is one of many risk portfolios of an investor holds, then non-systematic risk of each fund will be largely diversified away. Then only systematic risk of each fund. Suppose you have 20 funds to invest. Then you don't care about each individual standard deviation of each fund, right? You only care about the systematic risk each fund contribute. And remember, beta represents systematic risk. So that is why if this fund is just one of many risk portfolios you have, then use training ratio because this is systematic risk. So if training ratio is bigger than the market excess return, this indicates superior performance, right? So market excess return is actually the training ratio of the market portfolio. because the market portfolio has a beta equal to 1. So market excess return is equivalent to the Treynor ratio of the market portfolio, right? So in our case, it is this guy. This is a market excess return. But unfortunately, you don't have a number higher than that. You have a number lower than that. So next about alpha. Sometimes people call it Jensen's alpha because originally, many decades ago, it is Jensen who proposed that we should looking for alpha for performance measure. So sometimes people call it alpha, sometimes people call it Jensen's alpha, but they are same thing, just different name. And we are familiar with this alpha because we talk about this a lot. A positive alpha indicates superior performance, right? So sometimes this alpha also depends on benchmark, right? If you use just CAPM as your benchmark, this is CAPM alpha. If you use three-factor model as your benchmark, your alpha is called three-factor alpha. And the number, their numbers are different. But as a fund manager, what alpha should you report to your investors? You should report both, right? You should report CAPM alpha. You should also report three-factor alpha or four-factor alpha, from a French three-factor plus momentum. That's called four-factor. You also probably, nowadays, you should also report five-factor alpha plus profitability factor and investment factor. But anyway, if you see any if you see any manager only report you CAPM alpha, that's incomplete. That's incomplete. That could be misleading. And alpha sometimes is called risk-adjusted return. We talked about this before. And it is most widely used performance measure, okay? Actually, all those measures are widely used. So I don't know why this textbook called this the most widely used. Okay, but I think a good thing is alpha grab people's eyeball a lot. So people talk about alpha a lot nowadays. And of course, it relies on as a pricing model. I'll talk about it. It is Jensen's alpha or CAPM alpha, or it is three-factor alpha or other factor models alpha. And it's very easy to identify superior performance, whether the alpha is positive or negative. That's straightforward. Okay, so in our case, so how do I get this number alpha? Actually, let me erase this. Alpha is come from, let's go back a little bit. Alpha is come from actually a regression. This is your dependent variable. This is your independent variable. So in our case, we just do a simple linear regression, right? Let's do a simple linear regression to generate the alpha. Where's the regression? Regression. Then the y-axis is our fund's excess return. The independent variable, or the x variable, is our market excess return. Then we do a regression. Where is it? Then this is intercept is alpha, right? This is our beta. This is alpha. Remember, we talked about this before. Let's check whether the beta is the same as what we calculate. Beta 1.0034. 1.0034. That's right? This the slope or loading is called beta, but the intercept is called alpha, right? The intercept is called alpha, and the loading or the slope is called beta, and the intercept is negative. So this is our alpha. So what is alpha? Alpha is this guy. Oh, sorry. So is this alpha good or not? Of course it's not good because it's negative. So another thing about alpha is straightforward to tell it's good or bad. Just look at it's positive or negative, right? So based on all three measures, this fund all underperform the market portfolio, right? You have lower Sharpe ratio than the market. You have lower trading ratio than the market. Even if your alpha is negative, I don't know why this is ranked the third. I don't see the reason. So curiously, I don't know. And I think is even if alpha is widely used, but a positive alpha alone can't guarantee. Typically it is, but it can't guarantee. I would say 99% of the time it is, but it can't guarantee a better performance. Why? Because if you check the definition of the Sharpe ratio, look at Sharpe ratio is excess return, average excess return over the standard deviation of your portfolio, right? If the standard deviation of your portfolio, suppose you have, if you look at this standard deviation of your portfolio is standard deviation of this part, right? Alpha is just a number, so there is no standard deviation of alpha. So standard deviation of the return is come from these two terms, systematic risk and idiosyncratic risk. Systematic risk and idiosyncratic risk. So this is the variance of the systematic risk plus the variance of the idiosyncratic risk. That's a total variance of the portfolio. Then square root would be the standard deviation of this portfolio. So that's the definition of your Sharpe ratio, SR. Then we can rewrite the whole thing as this. And from this formula, you can see a positive alpha alone can't guarantee a better performance because even if your alpha is a slightly better, suppose you have slightly better alpha, but suppose your error term is very big. Suppose that happens. If your fund has a slightly better alpha, but your idiosyncratic risk is huge, then eventually your Sharpe ratio could be lower rather than higher. It all depends on the idiosyncratic risk. It also depends on your beta. So Sharpe ratio is a function of alpha, beta, and idiosyncratic error rather than a function of alpha alone. So that is why alpha alone cannot guarantee a better performance. Let's take a 10 minutes break. All right, let's come back. We should be able to finish earlier. So as I said, alpha can't guarantee a better performance, as you can see from this formula. The next measure is called information ratio. Information ratio is defined by alpha of the portfolio over the standard deviation of the non-systematic risk. Sorry, this is error term, right? So this is not standard deviation of the portfolio. This is the standard deviation of the non-systematic risk of the portfolio. Right? So it shows how much non-systematic risk was taken to learn excess return. Excess return is this alpha, right? So this is the definition of information ratio. I'm going to talk about when you will need this information ratio. Usually, this is a measure of hedge fund performance. Just for hedge funds, this is very widely used performance measure. Why? Why this formula? Because you can prove that if you're an investor and if you hold a market index fund or it's a well-diversified mutual fund, suppose it's a market index fund and a hedge fund, suppose 80% of your money is for a passive index fund, but 20% of your money you want to adventure, you invest in a hedge fund instead. So your entire investment would be a passive market index fund plus a very active hedge fund. Right? Suppose that is the structure, then your entire portfolio's Sharpe ratio, the square of Sharpe ratio, can be written, we skip the deduction, can be written as the Sharpe ratio, square of Sharpe ratio of the market portfolio plus this ratio square, and this ratio is information ratio. The alpha of that fund over the non-systematic risk of that fund. Then, according to this result, then investors should choose the hedge fund with the highest possible information ratio. Right? Highest possible this ratio to get the high Sharpe ratio for the entire portfolios. So that is when information ratio is used for. So we can sum up all those measures. Those measures are not independent measure, of course. They are not independent. They are pretty much dependent, right? They are positively related to each other. Typically, if you have a positive alpha, you will have a positive Sharpe rate. Sorry, you will have a high Sharpe ratio and high trainer ratio, and probably high information ratio. I'm not very sure about that, but those three are very much positively related. Right. So if you have a time, I provide the data for those three funds. Okay, if you have time, just find those measures for each of those three funds. Just play with the real data and get some sense about this alpha, Sharpe ratio, trainer ratio, information ratio, so on and so forth. Right? So the textbook also gave example to show you, suppose we have three funds. Those three funds are different from my three funds. They are not the same thing. Okay. Suppose you already measured the performance each of those fund A, B, C, and this table is provides you a list of the result of performance measure, alpha, Sharpe ratio, trainer ratio, and information ratio. So given all those numbers given, it will be very easy. Right? The conclusion would be fund A and B appears to be superior. Why? Because why A and B is better than C? Because both of them has positive alpha, and C has negative alpha. Obviously, this is not good. Second reason is both Sharpe ratio and trainer ratio exceed those of market index. The market index has Sharpe ratio and trainer ratio given like this, and both A and B has a higher Sharpe ratio than the market index. Both of them has a higher trainer ratio than the market index trainer ratio. So that's good. But which one is better? A better or B better? You would say A is ranked highest under alpha and trainer ratio and information ratio. But B is ranked highest under Sharpe ratio. Right? B has a highest Sharpe ratio. So it really depends on if your entire risky investment is in one fund, then you should looking for B. If B is the entire risky investment for you, but if you just choose one of in risky portfolios to invest, then fund A is better because it has highest trainer ratio instead. And of course, C has a poor performance, negative alpha, Sharpe ratio, trainer ratio, all smaller than that, those of market index, right? So this example is straightforward. And this is another example. It's a little bit redundant, but let's just finish this example. Suppose we have two portfolio, P and Q, and suppose all those numbers are given. We calculate those measures from the time series of their returns. Then if the fund represents the investor's entire investment, then which one? Portfolio P represents the market. So which one would you choose? Then if this is entire investment, just look at the Sharpe ratio, right? Then Sharpe ratio, which one is highest? This one is highest. Then the answer would be, okay, Q is better than P. Q is better than P because of higher Sharpe ratio. So Q is the one you're looking for. So if the fund is just one of many sub-portfolios of investors' entire investment, then looking for trainer ratio. Trainer ratio is somewhere here. So again, the answer is the same. Q is also better than P. But if the investor is seeking active portfolio, active fund to mix with a well-diversified index portfolio, then this is very much like a hedge fund, right? You looking for an active portfolio mixed with your market index, then you should look for the highest possible information ratio. The information ratio, this one, the portfolio P has the highest possible information ratio. So this is another example. Then I just move on to talk about market timing. And remember, this is not the first time I talk about market timing, right? We talk a lot about market timing in our week 3 or week 4, I don't remember. But essentially, what market timing means, if you can forecast the future trend of the market, if you forecast whether tomorrow the market will go up or go down, then you can choose your investment strategy, right? So if you choose tomorrow the market is going to go up, you will move your money from risk-free asset into the market. In contrast, if you predict the future market will go down, then you will stay away from it. So that is basically market timing. And we talk about that according to our research, or many people, not many people, I think the vast majority people in academia agree that it's very, very difficult to forecast the future performance of the market. So the conclusion is historical average return probably is the best way to forecast the future. Just historical average. The historical average of the U.S. market return is 7% or 80%. Depends on how long in the past you want to look back. And this paper, I talk about this paper, or I also test this paper also in our midterm exam. So just this paper re-examine all the performance of variables that have been suggested to good predictor of the equity premium. Equity premium is the market excess return. We found by the large, those models predict poorly. So those models can't help investors to time the market. But still, there is a question because those papers just examine all well-known strategy, and the conclusion is all those strategies don't work. But there is still a weak spot of this argument. So if you are a fund manager, you can still argue that you can do market timing. Given this result, this is just fact, you cannot argue against it. But even with this fact, still you can argue, I can do market timing. Why? Because I have some secret strategy that not well known, not been checked by your paper. This is my business secret. I don't want to tell anybody, but I can do it. Then if a fund manager argues this way, then can you do anything to test? Then it seems like no way. If he cannot review his strategy, how can you test? The answer is actually you can. Still you can, as long as he can provide you the performance. I mean, performance means the realized monthly return of his fund. He only provides you the realized return of his fund, just like the monthly return of 3 funds. All you need is the monthly return of his fund over the past 5 years or past 10 years or so. Then we can test, is there any secret formula he can predict the future of the market? How to test? That is a question I'm going to answer in the next few pages. So let's do step by step. So suppose he can have some secret ability. But to time the market, what he typically do is 2 steps. First, try to predict future market movement, right? Suppose he has this ability. He can predict future go up or go down. Then the next thing is shift funds between a market portfolio and a safer asset, right? That's what market timing means. If you predict tomorrow that's the market going up, you will shift money from safer asset to the risk portfolio. Right? If you expect high return, that's central, right? If you predict the tomorrow market will going down, then you will shift money from market portfolio to a safer asset. The market timing is just shifting money between market portfolio and a safer asset. Suppose you really have this ability, you can perfectly do market timing. Suppose you can. I don't know how you can, but suppose you can. Suppose you can perfectly forecast the tomorrow performance of the market. Then every time you predict future market return would be bigger than risk-free rate, you will invest all your money into the market portfolio, right? If you predict the future market return will be lower than risk-free rate, then you will invest all your money in the risk-free asset. Right? That's a natural, right? Because risk-free asset is always an option for you. So if tomorrow is good, you just go away from risk-free asset, just put all your money in the market. If tomorrow is bad, you will stay with the risk-free rate. It's very easy. So if you can do this, then realized return, suppose the vertical axis is realized excess return of your portfolio, and the horizontal axis is the realized return of the market portfolio, then the relation would be like this two red lines. Why? Because if every time if the market excess return is positive, you will 100% in this market, right? Then your return would be equal to the market return. So this slope is 45 degrees. If the market return is bad, negative, then you stay with the risk-free rate. Then your portfolio would be 0 excess return, right? Because you stay with risk-free rate, then your portfolio performance would be 0 excess return. So this is what your performance would be. Market is good, you go up with the market. Market is bad, you don't lose any money. You just stay with risk-free asset. You don't lose any money. So in this situation, you never lose, win, or in risk-free asset, right? So this is the relation of your portfolio performance, the relation with your performance with the market performance, the red curves. But more generally, people will do not 100% in, 100% out. A more general case of market time is if you can forecast the future, if you forecast the future market return is higher than the risk-free rate, you just partially shift, not 100%, partially shift money into the market portfolio. So your entire portfolio would have a higher beta, right? Higher beta means higher exposure to the market return, also means this proportional to the slope. If you predict the future market return is not good, smaller than risk-free rate, you will partially shift money to the risk-free asset, right? So the entire portfolio would have a lower beta. So as a result, your realized return will be something like this, a change of slope here. So what's the difference between this one and that one? Because this one, you 100% shift in and 100% shift out. So that is why here you can 100% safe. You never lose money. You win, but you never lose money. Here, because you just partially shift money in and out, so that means when the market is bad, you lose some money, but your lose is much smaller than your win. When the market is good, you shift more money in, so you win a lot. When the market is bad, you shift your money out, so your lose is not that big. Still, you suffer a little bit lose, okay? So that's the general case. I think most fund managers, if they can time the market, they will partially shift. No one going to 100% shift. I agree with me. So this is more general case. Then we go to a little bit more step. Because typically your portfolio will have non-systematic risk. Also, you cannot 100% right in forecasting future. You have some forecasting error, right? Even if you have ability to forecast future, but there is always forecasting errors. So then the relation between your realized portfolio return and the realized market return would not be perfect mathematical two lines, but those blue dots surrounding those red lines, right? Because there are idiosyncratic uncertainty and forecasting error. So the relation of your realized portfolio and the market will be something like this. But the key characteristics is there is a slope change. There is a slope change. This is more flat. This part is more steep. Can you see that? This part is more steep and this part is more flat. That means a slower, smaller slope. And this picture gives us a way to test. If you can do market timing, then your realized portfolio return would have a relation like this to the market realized return. Then how to test? This two authors just propose a way to. So by the way, Merton is also a Nobel Prize winner. So we talk a lot of Nobel Prize winners. So it's something. Every time I give you a name, have a chance this guy is a Nobel Prize winner. So Merton writes a way to test this particular feature, right? This is a realized return of your portfolio, and this is a realized return of your of the market. Suppose there is no slope change, then this additional term should be 0, right? There is no this additional term. But suppose there is really a slope change, then we just put a dummy variable here. This capital D is called a dummy variable. What is that dummy variable? Dummy variable is a variable D equal to 1 if it's positive, if this market access return is positive. But D equal to 0, otherwise, if it is negative, then D equal to 0. So D is called dummy variable. Okay. So what if this regression gives you a significant value of C? If this regression gives you a significant C, that means if you're in this range, your slope would be B plus C, right? But if you're in this range, your slope is just B. Can you see that? If in this range, your slope would be just B because D is 0. But in this range, positive range, your slope would be B plus C. Is that correct? So does there is an increase of slope is equivalent to ask does the C is significantly positive or not? And this is something we can test. So how? Just a regression, right? Suppose we have, I also post this on the Walto, the 3 fund or 5 fund. This is the same guy, right? Same name. This is a market, this is a model. This is a realized return of, I just choose the same fund just for convenience. This is the market access return. And the market access return times dummy variable, looking back, market access return times dummy variable can be written another time series. Remember what's the definition of dummy variable? If market access return is negative, then the D is 0. But if this is positive, then D equal to 1. So if this is positive, then this thing is same as before. But if this is negative, then this is 0. Is that clear? So if you want to do a regression, you just do the regress of this dependent variable to these two independent variables, right? Then we can do that easily. Data analysis, regression. Then in this case, this is our Y variable, the return of that fund. Then our X variable, we have two X variables, right? Okay, then go. We want to look at C, right? So this is intercept. This is loading on the first variable. This is loading on the second variable. Which one we should look at? This is the intercept A. B is a loading on the first variable. C is a loading on the second variable, right? So we should look at the loading on the second variable, which is here. This one, it's negative, right? This one is negative. So which means there is no positive value for C, right? Of course, even if you got positive, still you want to check T. But here it is negative, so there is no point for us to check T. So we don't have a positive value for C in this for that particular font, right? So there is no market timing ability for that font manager. There is an alternative way to do the test, very similar. Two professors in earlier year, they proposed a similar methodology to empirically test about the market timing ability. This is a little bit different from before. They use a square of the market excess return rather than a dummy variable. You can see if you have a square of the market excess return, then if you write the market excess return as horizontal, the portfolio realized return as vertical, then the slope would be B plus C times the market excess return, right? Can you see that? Then the slope on the right-hand side would be B equal to C times the market excess return. Then why they want to write the slope in this form? They want to show that the slope is a positive function of the market excess return, which means if the market excess return go up, that becomes steeper, an increasing slope. You can see the blue curve is an increasing slope. Slope is an increasing function of the market return. Why? As I said, if you can forecast the market, if the market is extremely good, you will shift more money into the market, then your slope would be steeper. Why? Because you're more of your money in the market, of course the slope would be steeper. But if the market is bad, you shift more money out from the market, then your exposure becomes smaller, then of course your slope would become smaller. You have less exposure to the market. So if you can really do this money shift according to your forecast, then this slope would be a function of this market return. Does that make sense? So in this case, again, we test whether you can really have this kind of slope. Increasing slope is equivalent to test whether you have a significant C or not, right? So that's very easy. Sorry. The same example. We have this same fund return over the past 10 years. We have the market excess return, and we have the square of market excess return, right? This is square. The square of market excess return, so this number is just the square of that number. It's very straightforward. Then what left is, then we can do a simple regression again. Do the regression, and the horizontal variable is, the y variable is fund excess return, and the independent variable, the x variables, we have two x variables, are market excess return and square of market excess return. And this is the result. So those two results are quite consistent with each other. Again, when you look at C, right, this is a C. Again, it's negative. There is any evidence that market timing. So negative. So we got negative C. So that is two typical way to test. If a fund manager say, I have some secret formula I just don't want to tell you because it's my business secret, but I have that ability to do market timing, then typically you can ask, can you provide your past performance, the return? If you have his past performance data, you can do a simple regression. This regression or that regression to check whether you can get significant C or not. And actually, people have done that. In academia, people have done this test to many, many different professional fund managers. And the conclusion is the both tests provide very little evidence of market timing. Very little evidence. So typically we'll say majority of them can't do market timing. From two points of view. The first point of view is the paper I talk about. If you look at their strategy, all those well-known strategy cannot generate good result. That's one way to go. Another way to go is even if they have some secret, they claim they have some secret strategy, you don't know their strategy, but still you know their realized performance. You just look at their performance, still you can see whether they have the ability or not. And the answer is still we don't have evidence that you can focus the future. So I think those two evidence are pretty substantial. Even if every day you look into the looking at the news webpage, everybody are trying to focus the future performance, but still the past average is the best way to focus the future. Okay, this is about market timing. Another thing I want to talk about is something called style analysis. Style analysis is a starting point of the style analysis is many studies have shown that asset allocation is responsible for a high proportion of the variation across funds in investment performance. So what does that mean? There are hundreds, maybe thousands of different funds in the industry, right? And there's good performance fund, there are bad performance fund in terms of if you just look at the return, of course, there are high return funds or low return funds. There are high risky funds or low risky funds, right? Funds are different, cross-sectionally different. But how to explain why they are so different? There are two types of job a fund manager can do. One is called asset allocation, and then the second is called security selection, right? Security selection is within each asset class, you have ability to select those superior securities, right? But the study shows that the asset allocation can explain a majority of the performance, the resulting performance. For example, asset allocation to asset class like T-bills. T-bills is a risk-free asset typically, and corporate bonds or other bonds, and stocks. So assets represent a big category, right? You decide your proportions to those asset category, that's called asset allocation. Then within each asset, you do security selection as a sign of your ability. But asset allocation explains the majority of those performance variations. The idea is, if a fund manager, he don't tell you what is his strategy, he claims he has a superior ability to do security selection. Everybody claims that I have ability to do security selection, but you want to prove that actually the performance is just because of your asset allocation, then that is some regression can be done by style analysis. You just regress fund return on indexes, which represent a range of asset classes. Right? A simplest case is, suppose this is the return of your fund. You regress to the T-bill, which is risk-free rate. In theory, risk-free rate should be constant, but in practice, it's a little bit time-varying. Also, the entire market index. So this is very simplest case. And then you look at the regression coefficient that will measure the fund implicit allocation to that index. Implicit allocation to that index. right? And let's go to an example. For example, suppose this example in this example, this is the realized return of one fund. This is called Fidelity's Magellan Fund. Anyway, this fund. If you have historical performance of this fund, you do this regression on a couple of indexes. Why this is indexes? You remember, up to this point, I just mainly talk about the market index, but actually nowadays there are many different type of indexes. All of them represent passive investment strategy. For example, this have Vanguard. Let me go. Come on. Oh, I don't need to have Australia. Okay. Okay. So, Vanguard is one of the largest money management firm, right? So look at Vanguard. But Vanguard funds are passive index funds. All of them are passive index funds, right? So what kind of index fund do they have? So we can look at Vanguard fund by asset classes. So there are many different asset classes. For example, where is it? Here, okay. So this is asset. There are almost 130, 129. For example, money market fund, this is one asset category, right? So if that represents, money market index fund represent this one, TBL. They're fairly close. There are tiny difference for each different one. And bond funds, this is another index fund, represent the fixed income asset class. There's some long-term or whatever, short-term, so on and so forth. Short-term federal. Okay. But this is not just one bond, right? This is a portfolio of bonds. And this is a portfolio of bonds, but it's passively managed. What's the next category? Okay, this stock fund, the large cap, which means large firms. This is index fund for large firms, for example, SP 500. SP 500, all of them are large cap, right? Another, and medium cap, those firms, not huge, not small, and small firm, and also so on and so forth, growth and So I don't want to go through all those lists, but the idea is all this independent variable represents one index fund. It's up to you to choose how many index funds you want to put on the right-hand side. It's up to you. You can have just like this example. This example has 1, 2, 3, 4, 5, 6, 7. You can have 7, you can have 10, you can have 20, you can have as much as you like. But what's the purpose of this regression? The purpose of this regression is want to look at the regression coefficient. Every time you do a regression like this, you will get alpha, C1, C2, C3, C4, all the way to C7, right? That is what a regression will tell you. Then you look at the regression coefficient or the loading, C1 to the C7. This is C1 to the C7. And some loading is close to 0. In this example, the textbook author should already do the regression, and this is the outcome the author represents. And this loading, C3 and C4 and C5 are non-zero. This is in percentage scale, so this is 35%, and 61%, and 5%. Aggregately, is 100%. So why is this coefficient important? Because what does that mean? The regression coefficient measures the fund's implicit allocation to that style or to that asset class. So if there is a loading, 35, then probably 1/3 of this, the funding allocation is to this medium cap stock, even if you don't know the true strategy of that fund. As long as you have their return, this is the information, the only information you have. You only have their return, but you can do this regression to find or to discover the true strategy of this fund. So this is like, you're like detector, right? You only have this information, but you want to find out their true strategy. And this coefficient will tell you the fund's true strategy. And this fund will focus a lot on this large cap stocks, the C2. The C2 loading is very big, 61%. So you can see, okay, from the information of the loading, this fund focuses very much on large cap stocks, right? There's a little bit loading on growth fund, so a little bit on growth. So that is basically, and the loading on other index funds are basically very small, close to 0, right? So this is the information about the regression coefficients. Another usable information is the R-square measured. The R-square of the regression measures the proportion of fund returns can be explained by this asset allocation. In this case, almost 97.5% of the return variation of this fund can be explained by those asset allocation, by those index funds. Only not explained proportion of return variability is only 2.5%. So if you claim you have security selection ability, then it only contributes to 2.5% of the return variation. So there is a very tiny room. What does this number say? The number says there is only tiny room you can play. The vast majority of your portfolio's return would be very similar to those index funds. Suppose I ask you a question. Suppose you are a superstar money manager. You give your investor a return like this. Then your investor do this regression to figure out this. Then would your investor leave your fund? Because I already know your investment strategy, then I don't want investing into your fund because you charge me management fee, right? Remember, those star managers are going to charge you roughly 1% per year, and that's expensive. Now I already know your strategy. I just want to stay away from you. I get all my money back. Then I buy those index funds. I put 1/3 of my money. I put 35% of my money to this index fund, 61% of money on this index fund, and 5% of my money and this index fund. Because index funds charge you almost zero fee. Remember, that's the whole point of index fund. Then, if I do that, then my portfolio performance will very much close to yours. 97.5% similar to yours. Right? That's what this R square means. There is only 2.5 difference between yours and mine. But the question is, would I do that or not? Typically, maybe you should do that to avoid be charged the management fee, but still, there is argument. Let me repeat this. The style analysis, the regression review the strategy that most likely track the fund activity. So if once you got this result of that regression, you can form a synthetic fund to represent that strategy. In our case, we just build our own strategy. That should be very much similar to that active fund. But remember, there is something missing. That's regression alpha. We don't know the regression alpha yet. What's the alpha? There is no such number in this. But in the book, actually, the alpha is known small. The alpha could be significant. I think the majority of cases is not significant, but the alpha could be significant. And in the textbook's example, the alpha is 0.32% per month. That's big. Then almost 4% per year. So it is very true that you can artificially go back. You can artificially make 3 index funds, and those 3 index funds can mimic the performance of this fund very much. But still, the difference between them is this alpha. And this alpha could be significant, which means you can mimic their performance, but still their alpha is much bigger than yours, because your alpha, by definition, is 0, right? Your alpha is 0, but their alpha could be bigger. So that is a funny thing is that the room that the fund manager can play is very small, right? There is just tiny difference between theirs and yours, but still they can generate significant alpha, even if the room is small. And of course, in summary, the fund performance related to the synthetic fund you just artificially built is a measure of fund manager's ability. So it's another way to measure a fund manager's ability is to make a synthetic fund based on the regression result, then compare the true performance of the fund manager with the performance of the synthetic fund. Then their difference should be a good measurement of the fund manager's ability. And this difference is sometimes called average tracking error. Also, it is technically the regression's alpha. It's a performance measure of your performance with benchmark performance. So the advantage of this evaluation is now you can decide your individual benchmark. You have a benchmark with many index funds as your benchmark. Rather than before, let's go back a little bit. What's the difference between that evaluation and this classical evaluation, Sharpe ratio, alpha, training ratio, information? All this, the benchmark is just the market rate. You can think the benchmark is just the market return as your benchmark. The market beta, the idiosyncratic risk relative to the market. So in other words, the classical measure of performance all based on the benchmark of the market performance. But in this case, you have a benchmark, not just the market. You have a benchmark with many index funds as your benchmark. In this case, you have 7 index funds as your benchmark. You can use 10, you can even use 20, as long as there is a meaningful loading, meaningful coefficient, then you can have a benchmark to measure this, to evaluate the fund manager's performance. So this is very individualized benchmark, just by this style analysis. So that's the whole point of style analysis, to have individualized benchmark. I think that's what basically today's material.